But a lot of people, I think, don't realize that another great way to become wealthy is not to pay a lot of tax. I like to say there are at least two great ways to get wealthy in America.
Welcome back, everybody, to another episode of the Big Hitters Podcast. I'm joined here by Peter Culver. He is the founder of a company called WellThrive. He is a serial entrepreneur. Goodness gracious, right before we hopped on this meeting, he was telling me about all the different ventures and enterprises he's involved in. Also, I found out that he's in Connecticut, which is where I hail from. So that is enough for me to know that I really like this guy. And he also does some real estate investing. He is a part of a number of coaching communities that has been very integral in growing his businesses. So, Peter, thanks so much for joining us here today.
Pleasure. Looking forward to it.
Well, my first question is always the same. Who are you and how did you get to where we are today?
So, Peter Culver, grew up in Connecticut, your old home state, skipping over a few years. I was pretty much educated there. I was originally trained as a lawyer, representing almost exclusively business owners. That's sort of the common theme there. And one of my business owner clients, who was crazy serial entrepreneur, became very successful, decided, you'd relate to this, he wanted to open at that time, this was 30 years ago, sort of a wealth management firm for people who either couldn't or didn't want to go to JP Morgan, Goldman Sachs, all that kind of stuff. So we raised a bunch of money to do that. In the beginning, I did the legal work. I was the lawyer who got the licenses and set up the contracts and all that kind of stuff. I don't think they thought very much when they were creating this entity of who would run it. And maybe that's because we didn't know if we'd ever get it off the ground, but we did. And basically someone said, well, we haven't identified anybody to run the company and you created it. So why don't you stop being a lawyer and you run the company? So I literally walked across the street in Hartford, Connecticut. You would know Hartford, and went from being a lawyer to running a small trust company and investment management company. And I would say I wasn't over there for more than a week that I knew I'd never go back to being a lawyer. So I've stayed in that industry the whole time in a variety of different capacities. I've started 3 or 4 different financial services type ventures. I worked for a couple of big financial institutions. But I started working about 20 years ago with another guy who's now my partner, initially in separate businesses. We just collaborated together, worked on joint projects. He's a CPA, I'm a lawyer. It was kind of a good mix. And I guess to make a long story short, those two businesses sort of coalesced to the point where it made no sense to have 2 separate businesses. So we put those together. WellThrive is a pure consulting company. So wealth management. So we do all the stuff in wealth management except manage money. And part of the reason for that is we have an RIA that when that's applicable, we can use that if our clients want to. We love to say about a lot of our entrepreneurial clients that they're all rich, but most of them don't have any money because all their money's in their company and they don't really like the stock market or whatever. So it's been a nice, it's another stream of revenue, nice place to park some assets. And then part of the reason we originally got together 20 years ago was we had a bunch of clients who had been used to sort of clipping coupons on muni bonds. And when the coupons were 5%, that was a great game. When the interest rates started to go down, we were looking for investments that were relatively stable, had good tax benefits. And that kind of led us into real estate. And that's been a bit of a story in and of itself. But today we probably own, through another entity, 4,500 units of multifamily housing, mostly in the southeast part of the country. So those are all entrepreneurial ventures, and they all have not so much the RIA, but the real estate and the WellThrive company. One of their primary focuses is to help our clients reduce their taxes.
Peter, I struggle with focus. I have a lot of great ideas. How do you stay focused?
Well, so I would say, I was mentioning before we got on, all these companies we run using a system called EOS, the Entrepreneurial Operating System. And part of the structure of EOS is companies have what are known as visionaries. So, strategic thinkers set the tone, sometimes a little crazy with too many cool new ideas. But the design of that system is another person known as the integrator really runs the business on a day-to-day basis. And you might think CEO, COO, right? So, and as it's evolved, our sort of typical pattern would be we'd start a new company, we'd work pretty intensively in it till we thought it was kind of stabilized and off the ground. And then either from the inside or the outside, we'd find an integrator to run the business, sort of the old, we love being owners of businesses, but we don't want to be the operators of all the businesses. So, there are ups and downs in that journey, but it seems to have worked pretty well. We have an investment guy that essentially runs the RIA. We have in this business, although this is probably the business that my partner Noah and I are the most active in because it keys into our technical expertise, which is helping people save money on taxes. The real estate business, we have a partner that essentially runs a business on a day-to-day basis, and we help with strategic decisions, but he's keeping track of all the properties day-to-day, month-to-month, that kind of thing. So
tell me more about the EOS. You're the second podcast guest I've had in 2 days that has told me about the EOS system. And I've read parts of the book Traction by Gino Wickman, but I've not.
Yeah.
So tell me what that system and community has meant to you.
Yeah, a ton. So I think, let's say you bootstrap a business, and if you haven't been exposed to EOS, you're kind of trying to do everything. You're accumulating maybe people over time. But I think at some point you can reach sort of a ceiling where it's hard to scale the business based on kind of your own skill set. So again, EOS makes this distinction at the top level between, you could either call them owners and then operators. The terminology that EOS uses is a visionary, and then an implementer, and then it has a concept which is sort of right person, right seat. So you want to make sure you identify what seats you need to fill and then get the right people in those seats, which sounds so logical, but sometimes not so easy when an organization is evolving organically. It also has you have weekly meetings of what's known as the leadership team. You have quarterly meetings. You have a big annual meeting. I think it just helps people that may not have grown up with a way to structure a business and keep track of it, throughout the course of the year or multiple years, just a nice structure. And it's not basically the way that, someone could implement it themselves if they read the book and picked up all the concepts. The way most people get into it is the whole, at the top of the pyramid there, if you're interested in EOS, a company can get affiliated with what's known as an implementer, and they would help you for a year or two install the system, make it operate right, all those kinds of things. So I would say the classic visionary person who's sort of spinning off cool ideas all the time and moving fast, it's not necessarily the best organized person. So it gives you a system and then helps you find the right people that can implement that system. So
That doesn't sound like me at all, by the way. Very,
no, in that structure,
yeah,
you might find, because part of, if you think about right person, right seat, in one sense, the initial design of the system is to make sure there's enough time for the visionaries to do what they're best at doing, right? So we don't want those people doing a lot of, you don't want to be the visionary and be in charge of the HR department. You'd shoot yourself,
right,
right? Or
right,
you just do a terrible job. So
right.
I think it's good. And if you think long term, if you have a business or you're a serial entrepreneur and at some point you think you might want to sell your business, this, one of the things that's most attractive to a buyer is a business that can run without the founder, right? Because they don't want to pay the founder. They want to get rid of him or her. So part of this system, which on the one hand is just designed to let that visionary person do what they love and do what they do best, it actually creates a good recipe for the sale of a business because they're not involved. I mean, they're involved in the sense of conversations and stuff like that, but they're not doing the day-to-day stuff. So it's we have found it valuable.
What sticking points are you experiencing in your business now? I mean, with your multiple businesses, every founder, every owner reaches some sort of a threshold they're trying to break through. What is that right now for you?
So I would say, and there are probably multiple points like that in all the businesses. Most of our energy right now is in this WellThrive business, and the lead service there is helping people save on taxes. So the key is finding the people that are your ideal clients, right? Now, we do reasonably well through all the traditional ways, speaking engagements, writing, but I think we're trying to master, in part through AI, how to scale up the lead flow. And so constantly pushing in that direction, right? Use it to help you generate leads. Use it to do initial intake things with leads, so that something else gets, say, someone like me or Noah to the point where if we have to get on the phone, we know the person meets all of our qualifications, is interested in what we do. We're not involved in the qualification. And I think up until somewhat recently, we've done all that by having people a little bit down the food chain just qualify those people either through questionnaires or telephone calls and stuff like that. And my sense is in today's world, I know, because we've been, chatting with people about that a large part of that could be automated, I think.
Agree. And I'd love to double click on that at some point and talk more about that.
Sure.
But it actually transitions perfectly to my next question, which is, how are you using AI? Where do you feel like you could be using it that you're not?
So I would say right now we probably use it primarily, I don't know, for lack of a better term, as a research tool, right? So we tend to get a lot of questions. Someone will just call up and say, ask us some random tax question. A lot of times we know the answer, but to be honest, a lot of times we don't know the answer, or we just want to double check. I think the answer is, but before I tell this guy or gal what the answer is, in 60 seconds, and it's remarkable how, maybe it isn't remarkable, but you can ask Grok or ChatGPT, whatever you use, a pretty sophisticated tax question, and they'll give you a good answer. So we use it a lot for that. We're trying to work through, we've built what is really nothing more than a gigantic Excel spreadsheet, which helps us develop analyses and proposals for clients depending upon how much money do they make in income, how big was their capital gain, what state do they live in, are they single, do they file married jointly, whatever. There's probably about 10 or 12 key factoids that then lead into what the strategy is. Now, again, right now we have a very sophisticated but somewhat old-fashioned spreadsheet that does all that work for us, which we built over the years. And my sense is we could use AI to train a bot to do all that. Hey, Andrew, I hear you made $1 million last year. You're paying way too much in taxes. Please answer these 10 questions, and have the machine give the initial answer, and maybe even ultimately guide the client through the implementation. So that's a thing we're trying to figure out if that makes sense. I think just fundamentally, I think our mindset is every time we have a process that's a repeatable process, to think to ourselves, could that process be streamlined, speeded up, save human capital by being automated using AI? So I would say, we're new to it, but we're eager to take advantage of everything it could do for us.
So the common tax strategies that I'm aware of, so I'm a financial advisor by trade, but I follow a lot of tax gurus on Instagram, and I see some of the cool tips and tricks, the cost seg studies on real estate, oil and gas investments, setting up charitable foundations. Like, what are some of the different strategies you employ with clients?
Sure. So I would say, and there are probably dozens, but I would say they kind of fall into two categories. So one, they're just some routine tips and tricks that it's surprising how many people haven't heard of. So two you haven't mentioned, but which you may have heard of, is something that is sometimes known as the Augusta rule, or sometimes known as dwelling unit rental. If you own a business, your business can rent your house from you for up to 14 days a year. The expense for meetings, and they have to be legitimate meetings, and I can unpack that if necessary, but let's just assume you were going to have a corporate retreat next Wednesday, and it was going to be at the Marriott in Cherry Creek or whatever the hell it is. But instead of doing that, you have it at your house. So that's still a deductible expense by the business because they're paying to have a meeting, and you would cater in the food and do all the stuff that you would need otherwise to do to have a business. That 14 days of income is not taxable to the homeowner. And the reason that's significant is, so some people will say, well, that's great. My wife would never let me have my people over. Or, who would rent my house? It's a mess all the time. But the real answer is you do a comparability study. So if we went to the Marriott or whatever the heck it is in Cherry Creek, what would it cost to have a meeting for a day? And the answer is, although the number varies around the country, it's probably something like $2,000. If you had a breakfast, you had a lunch, you had a cocktail party, maybe you have to have an AV guy in or something like that. So these are a guy we work with somewhat sillily refers to that. Well, that's a chip shot, right? So that's $28,000 worth of new income. Another one that's not dissimilar to that is something that is known as pay the kids, PTK. So under the tax code, you can pay your kid to work in your business up to, I think right now it's $14,700. They have to do real work. You have to keep track of it. You have to be able to substantiate it. We have a whole system that makes it easy for you to do that. But again, deductible by the company as long as the kid is doing reasonable work. But up to that 14.7, it's not taxable to either the kid or the parent. And then the little sort of tail end trick on that is you don't give the money to the kid. You put it in a Roth IRA account or put it in an investment account or put it in their 529 plan. So interesting tax. And also, maybe a nice way to begin to educate kids about working, right? So I would say those are kind of a little bit above what your CPA would tell you, but not the real needle movers. And so in that arena, we kind of divide the world into income tax strategies and capital gain tax strategies, right? So I was just on the phone an hour or so ago. A guy, he makes $1 million, and he just sold, this year he'll make $1 million, and he just sold his business for $10 million. So he lives in New York State, thank God not New York City, but he would probably pay on $1 million, $400,000 in income taxes in New York. I mean,
Yeah.
we'll probably chop that down to $100,000. Then and New York's probably the second worst state in America. California is the worst. That's 50% taxation. So
What's next? Massachusetts? What comes after New York and California?
yeah, it's probably, the places we love to work are New York, California, Connecticut, Massachusetts, New Jersey, that kind of thing. So that's income tax. There are a variety of things. So those are the sort of more mundane things. Now, the big needle movers are sort of a couple of things. One is making investments in solar installations, big commercial installations. And the reason those are really powerful is, and they're going to be even more powerful if the tax bill goes through the way we think it will, is first of all, solar equipment is equipment. It's depreciable like real estate, like anything else that's depreciable. Under the current law, the depreciation is accelerated to 6 years. So that's pretty good. The big, beautiful tax bill, whatever it's called, is proposing to compress that and put 90% of the depreciation in year one. So that means 90% of your investment qualifies for depreciation. The real benefit of solar is the legislation, provides for tax credits. So very simplistically, if you just think about the tax return, I make a bunch of money, that's my gross income. And then there's certain deductions off of gross income, the standard deduction, or if you're itemizing mortgage, charitable, all that stuff. So that gets you from the earnings down to adjusted gross income. So deductions are good, but they're only good up to what tax bracket you're in. Tax credits go dollar for dollar against tax. So, make up a number. I make this $1 million in California. I knock a little bit off. Let's say I get it down to 800, and California's going to say, well, you now owe me $400K in taxes, half of 800. So using certain strategies like solar, which have tax credits, those tax credits go dollar for dollar against the liability. There are certain limits, but you can drill a big hole in income tax liability. The thing that's also great about the solar legislation is, in general, there are caps on how much credit you can use in any given year. And the IRS doesn't want you to be able to totally squash your liability. But the solar legislation says, if I can't use all the credit, let's just say in 2025, I can carry the excess back up to 3 years. And what that means is I can file an amended return, apply the credit to a prior year, and get a refund. So, solar in the right state can probably reduce someone's overall tax liability by 40%, which is pretty cool. We also use a number of charitable donation strategies where essentially, you would know if I write a check to charity or I give an appreciated security to charity, the value and the cost of my deduction is right. I got to give the $10,000 to charity. It's going to cost me $10,000. I'm going to get some benefit based on the tax bracket I'm in. So there are opportunities out there. If instead of giving cash, or stocks, which are the equivalent of cash, a monetary asset to a charity. If you give a charity a tangible asset, two things happen. One, you can only take a deduction up to 30% of your adjusted gross income. So just assume somebody makes $1 million in income. They could make a charitable asset donation up to $300,000. What's out there in the marketplace at any given time are opportunities to purchase the asset that you're going to give to charity at a discount to its appraised value. So very often you could, using my example, $1 million in income, $300,000 deduction for a charitable asset, you might be able to buy that asset for $75,000. So that's what we call, there's an arbitrage there between the cost and the value of the tax deduction. Those are sometimes referred to as leveraged charitable deductions. And then there's a whole, depending upon what state you're in, what tax bracket you're in, how you file, there's a synergy between those two strategies, but it's not always the same, and it takes a little bit of tweaking to optimize it. So those are several income tax strategies. And then we have a variety of strategies that help people literally either, well, there are neat ways to defer a capital gain to future years so you don't pay all the tax in one year. There are ways to bring down the capital gain, and there are a couple of really interesting strategies to eliminate the capital gain. So some need to be put in place before the transaction, but some can be put in place after the transaction as long as it's in the same tax year. Like if I have a big capital gain in 25, the last opportunity I have to squash that is December 31st, 2025, because now I'm in a new tax year, right? So then it's analogous to something I'm sure you're very familiar with, which is tax loss harvesting, right? So I sold a bunch of stocks in my portfolio. I have a $100,000 gain. If somewhere I can find $100,000 worth of losses and realize those losses in the same year, then they cancel each other out. That's essentially what we do, just at a higher dollar value. So and the thing that's fun about this, I did it wasn't a speech. It was like a roundtable talk to a bunch of really rich people in Nashville in the fall. So I do my little presentations, 25 minutes or something like that. And then there was Q&A, and the people ask a few questions, and some just typical like high-strung ADHD entrepreneur stands up and says, guys, all of us in the room can afford to have the best advisors in America. Would you agree? And these are guys, I think they're in something called Tiger 21. You have to have $20 million of liquid net worth, and some of them are just off the chart. So they all nod their heads. And he says, why is it that we've never heard of these ideas from our CPA? And you mentioned this before we went live, which is what we really do is what we call tax strategy. We don't do tax returns, tax preparation, whatever you want to call it. And you need both, but the tax strategy is typically going to move the needle a lot more than the few simple little things that your CPA would tell you to do.
Peter, I'm sold. So obviously you've outlined the importance of tax prep versus tax planning.
Yep.
You clearly know what the heck you're doing. Where can people find out more about who you are and what you do?
Sure. So I'd say a couple of things. One, we have a website, a WellThrive website. It's just wellthrive.com. And that's the whole panoply of stuff we do, right? So, let's say we're working with you. Well, you have an RIA. So there's a bunch of stuff that we could do that you might want to do for the client. And we would say, fine, keep doing that stuff. We'll just do the tax stuff, right? But they would see the whole panoply of what we do. The other thing they could do is if they go to a URL, which is called Thrive Beyond Tax, all kind of strung together, and they click on that URL, they'll get two things. One, posted right on the URL are a bunch of books. Noah and I like to write books. Now we get them all written by AI, but that's fun. I mean, we have to come up with the idea, but and there's 23 tax tips your CPA never told you about. We wrote a long book about how to do an exit from a company in the most tax efficient way. So they can see some of those resources there. I think there's some webinars that we've done that are posted there. And on that funnel, if they want to, but only if they want to, they can fill out a form, and essentially that form would funnel to me, and they could talk to me if they want to. And I love talking to entrepreneurs. So that's almost my favorite thing to do. The last thing I'll mention is, and it's probably posted on our website, sometime in June, I could look it up. We hold a series of webinars for our community once a month called Thrive Talks. And it's on, some are on life coaching, some are on tax, some are on business stuff. But we're doing one in June, specifically a more robust discussion of the tax strategies that we just went over, super quickly. So they could just sign in and listen in and see what they think.
Peter, I'm not going to lie. This is probably one of my favorite podcasts so far, just because of you're just a really likable guy. You've been around the block. You've got a lot of different experience, and this was just a really a pleasant and a fun conversation. Thanks so much for joining.
I like to say there are at least two great ways to get wealthy in America. So one is to start a business, right? And hopefully take it to some significance and maybe sell it or live off of it, whatever you want to do with it. But a lot of people, I think, don't realize that another great way to save money, to become wealthy, is not to pay a lot of tax. And you'd relate to this instantaneously, because as investment advisors, when we have that hat on, we're always talking to our clients about the benefit of compound growth, right? So don't spend too much money, leave it in the market or whatever it is, leave it in your business, but let it compound over time, because over time, that makes a huge difference. I could show you a slide that we developed that shows the equally powerful impact of not paying taxes, right? So let's say I have $1 and it doubles to $2, but I have to pay a capital gain tax on the $1 that I made. So I went from 1 to 2, but then I immediately went backwards to $1.75. If you run that math out over time, it would blow people's mind how much more money can accumulate if you don't pay tax. So many entrepreneurs are very mathematical, and they get that. They'll get it instantaneously, right? So, and I think most entrepreneurs, it's not that, all of us have sort of a innate disdain of paying taxes. That's more visceral than anything else. But, and certainly a lot of tax money is spent on good stuff. But I think most entrepreneurs feel like, if I could take the same dollars that are going to go to the federal government, and I take those dollars and I do something valuable with my business, in my community, whatever it is, the overall kind of societal ROI is way better if you let an entrepreneur do that than a bureaucracy, usually.
Peter, this has been so fun. Thank you so much for sitting down with me on this podcast.
It was cool, man. And circle back, because I think you do something that we might benefit from, and we do something that you and your clients might benefit from. And if you wanted to kibitz on that, we could.
That's why I started this podcast, to grow my network and to meet awesome people like you. So thanks for joining.
Thank you, my friend. Have a good day.